You know that feeling when you're doing everything right with your money? You're saving diligently, you're trying to invest a bit for the future, you're paying all your dues, and then bam, you get hit with a charge or bill that you never ever saw coming. Well, that's been my life recently. It turns out I've stumbled into a few tax traps that honestly feel like they were designed to catch normal people out. Today I'm sharing the unexpected and frankly completely unfair tax traps that I wish I'd known about sooner. We're going to talk about how doing the sensible thing and saving can actually land you with a tax bill, the con that is the flexible ISA, and the absolute swindle of the student loan repayment system. My hope is that by sharing the mistakes I've made, I can help save you from getting caught out and help you keep more of your own hard-earned money. Because let's be honest, it's tough enough out there without feeling like the system is playing tricks on us. And just a quick reminder, I am not a financial advisor and this video is purely for entertainment and educational purposes. Alright, let's kick things off with one that has almost caught us out and gave me a real headache. Me and my partner worked so hard to put away a decent chunk of money for our future, and we found what we thought was a great high-interest saving account for it. But then I discovered the Personal Savings Allowance, or PSA. Here's how it works. If you're a basic rate taxpayer, you're allowed to earn up to £1,000 in interest from your savings tax-free each year. If you're a higher rate taxpayer, that allowance drops to just £500. Now, a few years ago, when interest rates were rock bottom, earning £1,000 in interest felt like a pipe dream. But with rates having gone up, it's getting easier to hit that limit. And if you go over it, even by a little bit, then you have to pay tax on the extra interest. We managed to remain just under the threshold, so we didn't pay any extra tax, but honestly, the effort we had to go to felt a bit ridiculous. We had to split the savings exactly between the two of us so we could each use our £1,000 allowance. We also had to make sure that the account paid interest annually and not just at the end of the 2-year fixed term of the account. It was a real faff, and it made me realize this is a trap waiting for people who are doing the sensible thing. You're trying to get the best return on your savings, but you are constantly having to check that you're not accidentally going to be penalized for it. So what's the big lesson here? The big takeaway for me was the importance of using your ISA allowance. In the UK, everyone gets a £20,000 ISA allowance each year. Any money you put into an ISA and any interest or investment returns you make from it is completely and totally tax-free. I'm now doing everything I can to make sure any savings I have go into my ISAs first. It's the safest way to make sure I stay under that £1,000 PSA threshold and keep all of the returns that I make. Okay, so that leads me nicely onto trap number 2, which also involves ISAs. So picture this. I'd successfully maxed out my £20,000 ISA allowance for the year. I transferred a big chunk of our savings into a stocks and shares ISA, but I was just holding it as cash in the account for a while until I decided on my next move. Then I thought I had a brainwave. I saw an opportunity and thought, great, my ISA is flexible. I'll just take some money out and pop it into a different ISA with another provider to take advantage of their offer. I found out the hard way that the word flexible comes with serious strings attached. It does not mean that you can flexibly move your money between different ISA accounts or providers as you please. It only means you can withdraw money and put it back into the exact same account within the same tax year without it affecting your £20,000 allowance. Honestly, why even call it flexible? The name is completely misleading. I don't think it's unreasonable to assume that flexible means you have, flexibility. This rule feels like a tiny bit of small print that's designed to trip people up. I was genuinely at risk of losing a chunk of my precious tax-free allowance for the year just because I misunderstood one word. So please, learn from my near mistake. Be super careful when moving money that's already in an ISA. If you take cash out of a flexible ISA, it must go back into that same pot in the same tax year. If you want to move your funds to a different company, you have to go through the official ISA transfer process, which the providers handle behind the scenes. Don't just do it yourself. And a quick shout out to the person who flagged this and helped me avoid this costly mistake. Right. This last one, this really gets me fuming. As many of you will know, I quit my full-time job back in December to focus all of my energy on Scrimp and Spend and creating content to help you guys. It was a huge decision, and it meant that my monthly income went from about $2,500 a month to basically zero overnight. Now, in the months leading up to that, I was dutifully paying my student loan repayment every single month. It's 9% of everything you earn over a certain threshold, and it comes straight out of your pay packet, kind of like a graduate tax. I just assumed that at the end of the tax year, the student loans company would look at my total annual income for the whole year, see that it had dropped significantly, and that I'd therefore overpaid in those earlier months. I was fully expecting some sort of rebate, even if I had to request it myself. They do check your annual income to see if you were liable to pay it all, and as it happens, my earnings for the full year were about $1,000 over the threshold. But here's the kicker. The amount of your repayment is calculated purely on a month-by-month basis. So all of those higher payments I made when I was earning a full-time salary, they're gone. For good. No rebate, no recalculation. It's a pay-as-you-earn system in the very strictest sense of the term. This is just so incredibly unfair for anyone who has a fluctuating income. If you're made redundant, if you change jobs, or you stop working midway through the tax year like I did, you can end up paying much more of a higher proportion of your actual annual income in student loan repayments than someone who earned the exact same amount but had it spread evenly across all 12 months. It's a system that punishes change and financial instability. There isn't much you can do to avoid this if your income suddenly drops, but it's about being aware. Don't budget for a rebate that will never come. Just know that the money taken out of your payslip for your student loan each month is very likely gone for good, no matter what happens later in the year. That said, if I had planned things out a little more carefully, had I known about this earlier and left my job sooner, I might have been able to get the full amount back. You see, this is why it is still a sore topic for me and still a trap worth knowing about. Another thing I found out while on the phone to the student loans company is that they wouldn't have informed me even if I had been eligible for a rebate. So yeah, if you ever think you've dropped below the threshold and want a rebate, definitely give them a call. So to quickly recap the traps to watch out for. Be mindful of that £1,000 personal savings allowance and get your savings into an ISA to keep them tax-free. Remember that a flexible ISA has some very inflexible rules. And finally, be prepared for the student loan system to not give you a single penny back, even if your income takes a nosedive. It's frustrating, isn't it? Sometimes it feels like you're navigating a financial minefield. But the more we know about these weird little rules, the better prepared we are. Managing your money isn't just about finding the best deals. It's about understanding the system so you don't get penalised for trying to do the right thing. By knowing these traps exist, you are already one step ahead. You can make smarter decisions and keep more of your money for yourself, for your future, and for the things that really matter. I know navigating all of this can be a real headache. That's why I'm so excited to be putting the finishing touches on an investing mini course that's designed to make at least one part of the financial journey that little bit simpler. It will take you step by step through everything you need to do to start investing in probably less than an hour. I'm going to be giving it away completely for free to the first 50 people who sign up to my email newsletter. So if you want to get your hands on it and finally get started with your investing journey, please click the exclusive link in the description of this video to sign up. I'd love to hear from you in the comments. Have you ever been caught out by a weird tax rule? Let's share our stories so we can all learn from each other. Thanks so much for watching. If you found this helpful, I'd be grateful if you subscribe to the channel so you don't miss my next video. Take care, and I'll see you in the next one.